Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to portfolio managers, to hedge fund managers, RIAs, and individuals. Basically, we help people get better returns in the stock market. There's been a lot of confusion and concern over the last few weeks in the cryptocurrency and stablecoin market. I personally have spoken to a dozen people in the area, and there is nobody who gives a better explanation of what's happening in the crypto and stablecoin space than Nicholson of Garden City Advisory. Mitchell, thank you so much for taking the time to be with us today.
Yeah, thanks for having me, Gary. It's a pleasure to be here.
All right. So to everyone who's listening in, this is a complicated topic. Mitchell does a phenomenal job at unraveling it, and we're going to try to make sure that this call is understandable and accessible to beginners and experts. But the chat function is open, and for any of you who have questions, just feel free to type it in, and we're here to help you understand it better. So, Mitchell, we're going to go to you now. First question. Obviously, the last couple of days have seen a ton of upheaval in the crypto market. Bitcoin cracked the $30,000 barrier and kept going. Maybe you can just help people understand what in the world is going on. Why is crypto losing so much value the last few days?
Yeah, sure. I think in general, people used to say the narrative that crypto was uncorrelated. As it was more adopted by institutions, it's really shifted. And I view crypto now as like an ultra high risk, high beta asset. I'm sure everyone here saw the CPI prints on Friday, and now all the speculation about the Fed doing not a 50 point, but a 75 basis point raise on Wednesday. So I think the lens to really view it is that it's a high risk on asset, and you don't really want to own risk on assets right now in the current macro environment. So yeah, I think in the short term, it'll be subject to volatility from those kind of factors, but in the longer term, there's still strong fundamentals in the crypto space.
Okay, fair enough. So let me ask you then. It sounds like you're saying for long-term holders. Okay, great. Sorry, we just had somebody who's on the call tell me that they were able to get on. Great. So it sounds like you're saying for people who are in the crypto space long-term, there's really no need to do anything. Just buy and hold and don't worry about short-term volatility. Am I understanding you right?
Yeah, if anything, I think this is a great chance to lower your cost basis or enter new positions into projects you've been keeping an eye upon. Maybe one thing to keep an eye out for is your counterparty credit risk, depending on what you're doing in the space. Not to point fingers, but a place like Celsius, for example, has a lot of counterparty credit risk. So if you're lending there, I mean, you can't really get your money out right now, but it's good to maybe at least review where your assets are and what type of counterparty credit exposure you have in the current conditions.
That's a great point. And for what it's worth, we're seeing similar conditions in the equity markets. I was reading an article over the weekend that some of the large, just call them too big to fail banks in the US, are so worried about using each other as counterparties on equities and derivatives that the Federal Reserve is stepping in to provide liquidity. And so what's interesting to me is so many people act like the crypto market is somehow so different from the rest of the financial asset market, but we're seeing similar
Oh, sorry, Gary, you cut out there. I think you were talking a bit about contagion.
Yeah, exactly. What I'm saying is we're seeing counterparty risk concerns in the equity markets. And the large banks are actually using the Federal Reserve to provide liquidity because they don't trust each other. To me, it seems like everything we're seeing is the same, and that crypto isn't really such a weird, different part of the market like some people pretend it is.
Yeah, that's a great point, except crypto doesn't really have the backstop of the Fed the way the big banks do. But conversely, we do have a lot of on-chain transparency. So in the case of Celsius, it's actually remarkable, but you can see their position on Maker right now. And I think they have something like 600 million notional. And you can see their liquidation price, which is basically about 16,000 per Bitcoin, in which case they're be fully margin called. So I think there's a bit more transparency, but also given the lack of a backstop or kind of a lifeline from the Fed, people have to change how they act. And I think that makes people actually more proactive in crypto because they know it's all on them. If they get liquidated, there's no one to see out, or if they're in a bad position, there's no one to throw them a lifeline.
Are you there?
Yeah. Can you hear me?
Okay, sorry, your video froze for a second. I think you're making a phenomenal point for everybody who's listening to this call. Really think about the implications of that, where by using the blockchain, you can look through and see what your counterparty risk is. Now try to imagine how much there's a lack of transparency if you want to know what JP Morgan, Morgan Stanley, Goldman Sachs, Merrill Lynch are holding, the risk they have. You can't get that information.
No, not at all. Especially not in real time, right? Like I could go on chain and look at Celsius's positions right now on Aave or Maker and know exactly what they're doing, and everything settles literally every 15 seconds or so as Ethereum transactions settle. So yeah, it's real time 24/7 monitoring. And then if you have a position on based on this kind of information, you can get real time feedback as well.
Yeah, that's you cut out for a second, but I think the point that you were making is that there's more transparency in the crypto market than there is in the equity.
Yeah, precisely, and that's due to the nature of the blockchain. I'm just closing on my applications in the back to help ensure that there's no lag on my side.
Yeah, that would be great. You've frozen a couple of times, so thank you. I appreciate it. Mm-hmm. All right. So the topic of the day that I really want people to understand better are stable coins. And I'm looking at the list of people on the call right now. We do have some people who are crypto experts, and we're going to ask all of you to be just patient with us for a minute while we explain to some of the new people in language they can understand. Mitchell, what is a stable coin? People have read about it. What is it?
Sure. I think you really have to go back in time to understand first why you would want a stable coin. So in crypto, long before Tether or USDC, Mark just said, it looks like it's freezing on your side, Gary.
All right. Good to know. I have some, I've checked. We've got a ton of bandwidth, but now I'm going to do the same and shut down other apps as well.
Okay, I can just keep going in the intro.
Yeah, let's keep going. But Mark, thank you. Oh, my video is freezing. All right, Mark, thanks for letting us know. I'm shutting down stuff, and hopefully we'll get that to stop as well. The good news is this is not the first webinar anybody's had where there have been tech problems. So we'll get through it. Thank you.
There we go. So yeah, as I mentioned, predating Tether, everything was Bitcoin denominated. So for example, if you traded an altcoin, let's say Ethereum against Bitcoin, it would actually have to outperform Bitcoin to actually go up. And you really had no dispersion in the crypto market. Where like if Bitcoin went up, alts went down unless alts went up more against Bitcoin. And then also from a business point of view, you want a dollar denominated asset that's native to blockchains. And that really didn't exist up until Tether and then USDC and now the plethora of stablecoins we have. So yeah, stablecoins kind of emerged out of necessity. They were quite small early on. In March 2020, BitMEX almost blew up. That was one of the largest derivatives venues. There they have a derivatives product called the perpetual swap. And with perps or perpetual swaps, you can basically trade spot, but with leverage. And it was entirely collateralized in Bitcoin. And when we had that massive sell-off in equities in pretty much every asset class in March 2020, Bitcoin sold off, but there was this convexity where you're long Bitcoin and then your collateral is margined in Bitcoin. So the P&L in your position's going down and your underlying collateral is deteriorating simultaneously. So that negative convexity is what caused BitMEX to almost blow up. And really everyone since then margins everything in stablecoins. So I would say the two biggest use cases of stablecoins are really now facilitating trading on crypto derivatives and then working capital, whether it's kind of providing liquidity in DeFi, lending or borrowing, day-to-day operations, even paying employees. I get paid in Tether actually. So yeah, I think it's really pervasive now how much stablecoins have been intermingled within the crypto ecosystem.
All right. So what I'm going to do, just again, because we have some beginners on this call, I'm going to repeat back to you in just plain language what I think you're saying, and let's make sure we've got it clear for people.
Sure.
First of all, when you're talking about alts, you're
Yeah.
referring to smaller cryptocurrencies, things other than Bitcoin or Ether, that people who maybe are running cryptocurrency trading strategies might be trading. It's not the kind of thing that like registered investment advisors are using. That's what you're referring to on alts, correct?
Yep, but I would say that there's some altcoins in 2022 that are like investment grade as much as you get investment grade in crypto.
Right. Okay. And then the way I think it may be best for people to think about stable coins is, let's say you're trading stocks in your account, you own 100 shares of IBM and you use dollars to buy that. You sell your 100 shares of IBM, you receive dollars in your account. In the cryptocurrency market, those trades settle instead of in US dollars. A lot of them on crypto derivatives will settle in stable coins, which are one way or another either dollar equivalents or pegged to the dollar. And we'll talk about the differences in a minute. Do you think that's a good explanation for people?
Yeah, precisely. The way to think about it, it's not the best analogy, but treat Bitcoin as your SPY, or as like your market, your kind of index, right? And it would be really weird to trade Apple against SPY as opposed to Apple against dollars, right? Because there's now a correlation between SPY and Apple. That SPY Apple trading dynamic is what happened before stablecoins, because like I said, everything was traded against Bitcoin, everything was margined in Bitcoin. And now with stablecoins, basically everything's traded against dollars, which is much more efficient. And you don't have that risk, as I mentioned, of being long crypto with crypto as collateral.
Gotcha. Okay. Right. So instead of, like you said, trading from SPY into IBM and back, you trade into dollars, and those dollars are used to buy your next position. Same thing in crypto. Instead of selling Bitcoin and buying ETH, you would have your intermediate position be a dollar denominated stable coin. Is that right?
Yeah, precisely. Typically Tether, or less commonly USDC.
All right, great. So super helpful. Now, one of the things that everybody's read about the last few weeks has been the implosion in the algorithmic stablecoin market. Obviously, there are people who are saying, what in the world is an algorithmic stablecoin? Does that mean the whole market's going to crash? So what I would love for you to do is help people understand, and correct me if I'm wrong, I think there are three main kinds of stablecoins. You've got algorithmic, partially collateralized, and fully collateralized. Is that right?
Yeah, correct. So maybe if we talk about like the fully collateralized first, those
Great.
are the largest, they're the most common. The two I'll talk about at a high level are Tether and USDC. Some similar ones are like USDP by Paxos, BUSD by Binance. But really, let's focus on Tether and Circle USDC. So those were the kind of original type of stable coins. They're the least dangerous. I was going to say safest, but maybe a better term is least dangerous or risky. What they do is they have a portfolio of treasury securities, commercial paper, basically fixed income securities that are the reserve. So let's use Circle, for example. You could go to the Circle, the issuer, which is a consortium between Circle, the company, and Coinbase. Now, once I have an account, I could wire them dollars, and then they could actually mint me a corresponding amount of USDC tokens on the blockchain. And then those dollars are added to their reserve, and basically every one token that is in circulation is redeemable for $1 of reserve that they're managing. The reserve for your Circle is actually managed by BlackRock, and its reserve is actually audited by Grant Thornton. So in that regard, it's quite secure and safe, at least on a relative scale. There's actually a product called, which one is it? I think it's Circle Treasury, or it might be Compound Treasury. One of the yield products on crypto that use USDC to generate yield actually just received like I think a double B rating by S&P. It's basically like high yield credit now. So that's quite remarkable. So that's Circle, the stablecoin. Tether is larger. It's offshore. So they actually are managed through Tether, the issuer, who works with Deltec, the bank. I want to say I think it's Bahamas, or it might be Cayman Islands. Similar structure. They manage a portfolio of treasury assets. Unfortunately, there's a lot less transparency. They don't have as reputable of an auditor. They don't have as familiar of a treasury manager as, say, BlackRock with Circle. But it's larger, it's older, it has stronger network effects because it's used everywhere, and it really serves a different clientele in crypto. So that's Tether and Circle, USDC. The next group is...
Wait, hang on 1 second. I want to ask you a follow-up question on Tether, if you don't mind.
Sure.
So one, you made a point of noting that Tether is offshore, and that's really important. And I want to talk about two things here, or rather get you to talk about two things. One, I know you've made the point in the past about why it's so important to have an offshore stablecoin available for trading. And we should explain that to people. By we, I mean you. And then the other thing is we're talking about Tether as fully collateralized. And there's a big debate going on that. And I know you have opinions on that. Let's just take a side road right now. We'll get to the other stable coins in a minute.
Sure.
But let's talk about those two points, because I know you have really strong, interesting opinions on both of them.
Yeah. So maybe we'll talk about the reserve first, and then we'll talk about the offshore component.
Okay.
So if going back to 2018 November, Tether broke its peg the first time. It was like about 90 cents. The reason why is it was like kind of subject to shadow banking. No one would really bank them. They were getting assets frozen around the globe. I think some in Portugal. I can't remember where else. But long story short, it was really difficult to redeem the Tether tokens for dollars in the reserve. Okay. Now, that redemption mechanism is essential to keep the peg because you need confidence in this product. If you can't redeem, people will sell on the open market, and then that will cause Tether to break its peg. And that's precisely what happened in the fall of 2018. Now, today, fast forward, Tether has secure banking with Deltec. They have a strong relationship together, so redemptions are actually much more feasible. I think there was about 15 billion in redemptions over the course of the last month or so, or excuse me, maybe last 2 months since basically UST blew up. One thing to note, though, as I mentioned, they don't have a strong transparency around the reserve because they don't have someone like Grant Thornton auditing it. It's a local Cayman firm, I believe, auditing it. That being said, beyond the reserve transparency, it's also the quality of the reserve is lower because they have more risky assets like commercial paper, particularly like I think foreign commercial paper. I think they have a lot of exposure in China, but it's not well understood. They also have some crypto backing Tether. It's also not clear really what assets and how much. And they actually have an outstanding loan with their sister company, Bitfinex, which is a large crypto exchange. So my point being is there's less liquid or illiquid assets backing Tether. And one of the really big concerns I have personally is that as they face redemptions, they're likely to redeem the higher quality collateral first, right? Because it's more liquid, it's easier to redeem at a higher pace if they're facing immediate redemptions. But then the concern is that the lower quality collateral is starting to make up a higher share of the remaining reserve. So if the low quality collateral was, let's say 10% for easy numbers, and then they faced 20% redemptions, well, then the lower quality collateral represents a much larger share of the remaining reserve. And then I think kind of the connection that I have is that if there was another big run on Tether, there could be a concern that it would break its peg. That being said, I weight this risk quite low just because of how systemic Tether is to crypto. Frankly speaking, all the major exchanges would blow up if Tether broke its peg substantially for a substantial amount of time. To put numbers to it, I think if Tether went to 85 cents for 2 to 3 weeks in a row, it would be disastrous for crypto derivatives because it's unclear how they should all settle. And crypto derivatives, they don't have a large share of open interest relative to the overall market, but it's where the bulk of liquidity is. So if there was problems in settling the futures and options and perpetual swaps on crypto, it would be probably a big issue. And the reason why I say it's unlikely to break is because there's really rich entities behind these exchanges. And those are the ones that stand to lose a lot if Tether breaks its peg. So those are the type of organizations that'll defend the peg before it breaks. So the point to kind of bring it all together is I think there's material risk. You'd be foolish to think there isn't. The probability that the risk actually materializes, I think, is actually overstated and relatively low. And the reason being is that there are a lot of powerful people in the crypto space that want to ensure that this disruption doesn't happen.
All right, so let's walk this through for people to make sure it's easily accessible. What is the current size of Tether?
Let me pull up the exact number. My initial guess, maybe
70 billion?
60, 70 billion. Yeah, it depends on the number of redemptions.
Right, okay.
Yeah, so notional outstanding here. I got it right here. Yeah, about 70 billion.
All right, so 70 billion. And, you know, there, as you pointed out, there have been issues with the audit and how much transparency they've allowed. But, you know, you follow this more closely than anybody I know. What's your best guess on the amount of non 100 cents on the dollar assets in the portfolio there?
So, I mean, there's assets that could be liquidated over a shorter or longer period of time that would yield pretty close to $1. And then there's stuff that's totally illiquid, right? And there's an important distinction there, right? Because if the problem is just that it's temporarily illiquid, I don't think it's as big of a concern. It's the stuff that's truly illiquid that it's not clear how that should be valued. Frankly speaking, I mean, at 70 billion, it still has, I think, quite a lot of high quality collateral. So I don't know how to place a number, but I would say something on the order of 5 or 10 billion is probably really illiquid, or something that should be marked down to maybe like 70, 80 cents on the dollar.
Okay. So if that's the case, if you got, say, $5-10 billion of illiquid assets in there that maybe aren't 100 cents on the dollar, if Tether were to get redemptions on, say, 50 billion out of the 70 billion outstanding, they'd be able to meet that. Is that right?
Yeah, in principle, but it's much more nuanced. And I think it comes back to the first question you raised about it being offshore, right? Like, I mean, frankly speaking, if you're in a country that has capital controls that you want to have your money in an offshore bank account, Tether actually serves a great purpose. And it's not clear how to weight the risk of keeping your assets onshore or somewhere that could be seized, or even in somewhere like the US, right? Like if you move them offshore, you probably don't want them in USDC. You probably actually would pay a premium to have them in Tether, in Deltec, in wherever it is, Cayman or Bahamas. So my point is, I don't think it'll ever get redeemed down to 10 or 20 billion because of the fact that there's just this persistent demand that there's really no substitute for. And like I said, there's a lot of organizations that back it, that use it as collateral for derivatives. Like, I mean, some of this volume is probably fake, but CoinMarketCap's quoting 85 billion in volume on 70 billion in assets. So like the velocity on this is absolutely insane. It's turning over 100% of the float daily, not accounting for.
No, go ahead. Sorry, please continue.
I was just saying that's just the spot volume. It's not even counting for like how much derivatives volume is using Tether as collateral. So like I said, it's very systemic. It's fully ingrained in these exchanges. So it's not something I think that can be redeemed entirely, nor will it in the near future.
Okay, so basically what you're saying is there may be, out of 70 billion of assets, 10 billion that are illiquid. If those 10 billion should trade at 70 or 80 cents on the dollar, then what Tether really has is 10 billion of assets that may be subject to timing issues, and total potential loss of value on that 70 billion is the 20 or 30 cents on the 10, or 2 or 3 billion. And you're pointing out that for a large part of the world, they don't want to have assets in the United States. For instance, if you were Russian or Chinese, you might not want to have your assets in the US. And so you have a lot of use of these stable coins. And you also have a lot of people with a huge amount of money in the crypto market who have a vested interest in not seeing Tether break the dollar. Now, if it's at 95 cents for a couple of days, no big deal. But What you're basically saying is for these people would be a relatively small amount of money, they can stabilize this particular stable coin, and there are people who have an interest in doing that. Does that sound like what you were saying?
Yeah, precisely. Exactly.
All right. And so for everyone listening, you know, in the crypto market, there's been a lot of concern about what if Tether breaks, right? Would there be this horrible situation? Would crypto go away? Would it implode? Would the market value collapse? And the point that we're making here is Mitchell has just given everybody a really clear understanding of what it would take to collapse the Tether market and explain why it's very unlikely, why there's very little money at risk, and why there are a lot of people who have a vested interest in ensuring that even the small amount of money doesn't cause a collapse in the Tether market. And that's, I think, the key thing that people have been worried about lately. Does that make sense to you?
Yeah, for sure. And I would just add, you're already seeing this substitution. So Tether had 100% market share maybe 2-3 years ago. I think now it's about 60-70%. And it's probably going to continue to decline. And I think that's healthy for the market, right? I think it's important that USDC and other stable coins, particularly the ones by, like, say, Paxos, who are the most conservative in their collateral, it's important those ones take more market share, right? It's kind of something that I think will naturally fix itself as the market share and reliance on Tether goes down. And I think that's the ideal outcome. I think there'll always be some share of people that use Tether, but it's not the case that it'll be the dominant stablecoin in the long run.
You know, Mitchell, I'm really glad you brought that up, because when you and I were talking and preparing for this call, I think one of the most interesting points you made was that a sudden collapse of Tether would be a problem, but a gradual phasing out of Tether to the point where you get to the point where this few $1 million of either illiquid assets or assets that aren't worth 100 cents on the dollar just become irrelevant because it's not the primary medium of exchange anymore. And so the issue is, if this replacement happened quickly, it would be a problem. As long as it happens slowly over time, the market remains stable.
Precisely. Yeah, exactly.
Okay, great. Yeah, we want to make sure that, you know, people really understand what the real risk is here. And there is risk, but at least understand where it's coming from and the conditions where we'd have a problem, conditions where we wouldn't.
Yeah. And I think it's really a forceful transition from Tether to Circle is the big issue. Like the slow transition is ideal, I would argue.
Agreed. Okay, so how long did it take for Tether to go from 100% of the stablecoin market to the current 60%?
Yeah, sure. If you go to the Block dashboard, it's a great resource. The Block is a fantastic news and research team, probably the best in crypto. Their data is free to use. And now I'm just pulling it up right here. So if I go to Stablecoins, there's a great chart that looks at market share. I'll put the link in the chat here, but if you're
that would be great for everyone who's listening, who's interested. Mitchell's going to put the link up, and you'll be able to check this on your own. There we go. It's up. So you know what? I'm not sure, Mitchell. I'm not sure if everyone can see it. So if everyone will indulge me, I'm just going to repeat it. You may see it twice, but there it is. Okay, Go ahead.
And there's the second graph. You'll see it. The first one's the total outstanding supply, which is an unbelievable 160 billion. What's more interesting is the market share. So the share of total stablecoin supply across tokens. And yeah, so if I look at Tether back in late 2018, before it broke its peg the first time, it was 100%, basically rounding error. It slowly drifted down. It stayed throughout 2019 and 2020 around 85%, 80%. So about a fifth was non-Tether. And then it's precipitously declined from about 85 now to a present amount about 50. And the largest constituent is USDC, which is now up at about 30%. And as I said, Circle USDC is audited by Grant Thornton. It is Treasury is managed by BlackRock. It's really the gold standard when it comes to stablecoins now.
Okay, so it sounds like Tether has lost roughly 50% market share. It's gone from 100 to 50 over about 4 years
Yep.
and lost about 20 or 30% of share in the last 12 to 18 months, right?
Yeah, precisely.
So where do you think Tether is a year or two from now as a percentage of the market?
Maybe 35. I think there's a floor. There's definitely a floor because, like I said, some exchanges will still use it as collateral. People will still hold it. I think it's more likely that issuance of USDC continues to pick up so that its market share grows rather than Tether's share is declining because of it being redeemed.
Right. You're saying Tether won't be liquidated. It's just USDC will continue to grow at a faster pace and just be a bigger percentage of the overall market for settlement of crypto.
Precisely. Yeah. The idea is that the pie is going to grow. I'm bullish on stablecoins growing as a whole, but I think, yeah, you'll see more issuance and money flowing in through Circle as opposed to Tether.
And as that happens, the systemic risk to a Tether blow up or to Tether being mostly collateralized rather than 100% collateralized or having some sort of timing issue on illiquid assets, that means that that risk fades into the background.
Yeah, exactly.
Okay. Sounds good. All right. And so, and again, you were talking about the value of it being offshore. For everyone listening to this, just imagine if you were, if you wanted to own cryptocurrencies or trade cryptocurrencies and you were in Russia, Venezuela, China, Cuba, you can imagine why you might not want your assets domiciled in the United States. I don't think that requires a lot of national security discussion there.
Yeah. And I'm not trying to make a value judgment on whether that's good or bad. It's just kind of the state of play right now in crypto and the nature of the market participants as well.
Sure. By definition, cryptocurrency assets are not national assets. They're international assets. And so we're not saying good or bad. We're merely trying to explain the world as it exists.
Precisely. And I would actually change your language a little bit. And I wouldn't even go so far as to say international. I would say non-sovereign.
Yes, that's a great point. You're right. It's not the IMF, the International Monetary Fund, the United Nations is not in charge here. One of the things we love about cryptocurrencies is there are no national governing boards, there are no international organizations, there are no governments that are in charge here.
Yeah, and maybe just to make it concrete, I remember thinking back when Biden was elected and there was some concern about whether or not he was fairly elected or whatever. And I'm not trying to make this political, but my point is Bitcoin was probably the only asset class that would continue operating through that period no matter what, right? I mean, bonds, equities, everything else is going to be impacted in one way or another, but no matter the outcome of the election, it has zero bearing on how Bitcoin performs. It just keeps chugging along, and the same is true of ETH. How investors respond to that election is one thing, but how the underlying protocol operates has zero impact on, or sorry, the political elections have zero impact on it. And then that's truly what I mean by non-sovereign.
Yeah, that's a great point. And I think you're right. The networks will operate whether governments rise or fall, whether democracy is healthy or in peril, whatever it is, cryptocurrencies will continue to operate. But the fact is, it will affect the value to the extent that political uncertainty is typically bad for the dollar. Political decisions to spend or overspend will affect the value of the dollar. Political decisions to affect interest rates will affect the dollar, and the dollar's relative strength to Bitcoin or to Ether affect the dollar denominated price of those assets.
Yeah, very well said.
All right. Great.
Gary, should we jump into the other classes of stablecoins?
Definitely, yes.
Okay, great. Sorry, I'm just making sure everything's going okay here. Right. Yeah, so we'll go into crypto collateralized, and then we'll end with algorithmic. And Terra UST, the one that blew up in May, that one is the third category, algorithmic. So crypto collateralized is very interesting because USDC and to a lesser extent Tether can still be censored, right? there's still a degree of control. I mean, BlackRock has the reserve of USDC, right? It's quite centralized still. So the idea of crypto collateralized is to make something more decentralized. So, excuse me, to have a dollar denominated asset that is more decentralized in nature. So the biggest issuer is Maker. MKR is the kind of governance token, and the protocol is Maker. And then it's governed by the DAO, Maker DAO, and the product, the stablecoin, is DAI, DAI. Now, DAI is interesting because it is crypto collateralized. So, for example, I could deposit $1.50 into Maker and mint $1 worth of DAI. So, what I'm doing is depositing crypto assets and minting the stablecoin. And I have some loan to value. And what's really remarkable about Maker and the whole protocol there is that it can actually facilitate liquidations if there's margin calls that are not met. And DAI is remarkable because I'm just looking right here. I think it has over 10 billion in outstanding assets. Sorry, let me look on this graph. Yeah, it peaked at 10.2 and now it's at about 7. So there's been some underlying redemptions. But yeah, it's never really broken its peg materially in the last while. It did briefly in 2020, but it's by far the most battle-tested and robust crypto collateralized stablecoin. And the key is that it's over collateralized. So when we make the distinction with algorithmic versus crypto collateralized, it's really the nature of the backing. So Tether, USDC, the kind of the dollar denominated ones, the dollar reserves, those are basically 1-to-1 backing. The DAI is more than 1 to backing with crypto as collateral. And then as we get to the third case, algorithmic, that's again 1-to-1 backing, but with just crypto collateral. And that's why it's the most risky and why basically Luna and UST broke up or blew up. Do you have any questions, Gary, on the Maker kind of crypto collateralized version, or should we jump to the third case?
I think the only one is, can you help people understand why you would need $1.50 of assets to mint $1 worth of stablecoin?
Yeah, I use that number just kind of arbitrarily. I think the highest loan to value is like 80% on ETH. The reason is the underlying collateral is so volatile. So you need that threshold in place where the Maker protocol remains solvent and it can liquidate it, like the crypto collateral, without basically having an issue where its total reserves that are crypto denominated fall below the amount of DAI in circulation. So you kind of have a loan to value that's less than 1 and probably typically less than 0.8. And actually what's really remarkable is the governance of the Maker protocol determines the risk parameters, such as the loan to value or the maximum debt that can be minted per collateral type, so that it's able to remain solvent in every circumstance.
Okay, got it. Great. All right. And then one last kind of stable coin you wanted to talk about.
Yeah, the algorithmic, the third type. So this one, Luna is the largest. Ironically, they didn't learn from it, but Tron is doing something with USDD. The Near protocol is doing something with USN. So the protocol, the token is kind of Luna, Tron, Near, and then the stablecoin is like some variant or flavor of UST, USDD, USN. So the idea where the algorithmic part comes in is that there's a mechanism in place where you can take the current price of the asset and mint the corresponding amount of the stablecoin. So if 1 Luna was worth $1 or $100 and you put 1 Luna in, you could mint $1 or $100 of UST, less a small fee. Okay. And you can algorithmically mint and redeem continuously. There's actually some gates on how much can be done in a daily period based on the protocol, but the idea is that there's an algorithm behind the minting and redeeming process, which is basically done at par with the crypto asset. So let's just focus on Luna and UST. The problem was basically as Luna declined in value, the ability to defend the peg decreased. And then it got highly reflexive once the market cap of Luna was less than the total UST outstanding. Because if everyone were to try to redeem, there's basically not enough to redeem. And that's when you saw it go from, I think, $30 per one Luna down to zero, basically. I woke up, I remember that day, and I saw Luna at $1, and I thought UST came back to its peg, but then I realized the underlying collateral actually deteriorated like 95% overnight after going down 80 or 90% already.
Right. So basically, the algorithmic stablecoins work well while they're working well, but as soon as there's a problem, there's a huge problem. They either work or they don't. And once they stop working, everything enters basically a death spiral.
Precisely. Yeah. That's what I mean by the reflexivity. And,
Right.
and I want to comment here. Obviously USDC works, and that's one flavor, but it lacks decentralization. In terms of a more decentralized stablecoin, Maker and Dai, I'm bullish on that approach. I think that over collateralized with crypto solution can work. I frankly don't see how you could have some type of algorithmic stablecoin with a similar mechanism as UST and Luna that works. It's too reflexive, as you said, on the way down.
Okay. Got it. Well, that's been incredibly helpful. Mitchell, I know we've taken up more of your time than we promised to. You've been amazing in these explanations. Anything that we're missing or anything that that we should be talking about and haven't so far?
Yeah, I could cover that. Maybe just a quick, anyone in the chat who's here, if you want to ask a quick question before we end, I'd love to take any questions from the chat. And maybe just one thing to kind of take away from all of this and more generally in the crypto markets. Look for the assets and the protocols and the applications that haven't broke, because those are the ones that are truly battle tested. And there's no lifelines, as I said, there's no talking to the Fed, there's no credit lines from banks. It's just a protocol that's running as intended, that's written in the open source code. And I think the ones that survive are the ones that are going to grow and continue to grow. And yeah, I'm still bullish on DeFi. I invest pretty much entirely in crypto. I don't really hold much equities. I'm in a lot of stablecoins right now, but I plan on redeploying. And I really just want to emphasize that I think DeFi is here to stay. The notion of being able to borrow and lend on chain, being able to trade assets on chain, being able to access structured products, cross-border payments, all of these financial applications that are enabled by Ethereum and DeFi, I think they're going to be world-changing. And just to reiterate, right, like I could send 100 million USDC to anyone anywhere in the world, and it would settle in 15 seconds. And that is remarkable, especially once you have the on and off ramps where it's seamless to go from $100 million to 100 million USDC. Like, I wouldn't be surprised to see more yield products get high yield credit ratings. I wouldn't be surprised to see more banks offer like the ability to send payments cross-border in USDC. I mean, look at JP Morgan. They've already took a page out of crypto's book with their JPM coin, right? It's kind of like a stable coin. It's not really a true stable coin because it represents bank deposits at JP Morgan, but like there's industrial versions of this. Even Facebook's Libra or Diem that they just kind of banned,
Right.
or sorry, they gave up on. But I guess that goes to show you, just as one last point, I guess in crypto, you get further with, what's the phrase? Begging for forgiveness than asking for permission.
Right. Yeah, that's definitely true in that market. So, Mitchell, these have been incredible explanations for everybody who's listening. Mitchell does amazing consulting work. He works with asset managers, with hedge funds, with family offices. Mitchell, for anyone who's listening to this, if they're interested in what you're doing, how do they find you?
Yeah, I kind of work behind the scenes. I haven't really set up everything like a website and stuff yet. My email is Mitchell with 2 L's at gardencityadvisory.com, or you could just find me on Twitter at WR_crypto. Shoot me a DM and we can go from there.
All right. Well, the man who's both hard to find and available on Twitter sounds like the perfect encapsulation of 2022.
Especially in crypto. Yeah. Thanks so much for having me, Gary. It's been an absolute pleasure, and I look forward to being back the next time.
Mitchell, thank you so much. We really appreciate getting your time and expertise.
Have a great day, everyone.
All right. Thanks a lot. Bye, everyone.